Warren Buffett once said, "The Intelligent Investor is the best book on investing ever written." And he also admitted, "Reading this book at 19 changed my life." And here's the interesting part. This book isn't about magic methods to predict stock prices, and it's definitely not about get-rich-in-one-week schemes. It doesn't even try to teach you how to guess what the market will do next. Instead, it does something much more valuable. It teaches you to think differently about money, risk, and investing. In simple terms, it doesn't teach you how to chase wealth. It teaches you how to build it, calmly, and without destroying yourself with dumb mistakes. Today I'm breaking down the 5 key ideas from this book. Ideas that will help you stop panicking, stop doing stupid things, and start making decisions like a truly intelligent investor. The first idea is called Mr. Market. Imagine you own a small, cozy coffee shop. Regular customers, steady profits, nothing crazy. And every single day, your weird neighbor bursts in. Let's call him Mr. Market. One day he storms in yelling, "I'll pay you $1 million for your coffee shop. This place is a gold mine." The next day he walks in looking depressed and mutters, "Coffee is dead. I'll give you $50,000. Sell it before it's too late." And he does this every single day. Now ask yourself, would you take that weirdo seriously? Of course not. You'd probably laugh and say, "Bro, come back when you sober up." But here's the strange part: when it comes to the stock market, people listen to their own Mr. Market like he's some financial guru. Stocks go up, everyone feels like a genius. Stocks go down, panic, selling, and screaming. It's all over. Why? Because the market looks serious. Numbers on a screen, charts everywhere, TV hosts in suits. It all seems official. But in reality, the market isn't that different from your emotional neighbor. It swings between euphoria and depression for no logical reason. And that's Benjamin Graham's key insight. The market isn't your boss, it's your servant. It simply offers you prices, and it's up to you whether to accept them or not. When everyone's panicking and prices drop, that's when opportunities appear. When everyone's buying stocks like free candy, that's your cue to slow down. During the 2020 crisis, Microsoft, Apple, and Amazon stocks were dirt cheap. Not because the companies were bad, but because Mr. Market was having a full-on emotional meltdown. And here's Graham's main point. Your job isn't to guess where prices will go tomorrow. Your job is to understand the value of what you're buying. If you own a coffee shop and know it brings in steady income, you don't care what your neighbor thinks. You won't sell it just because he's in a bad mood today. It's the same with stocks. If you understand the business, its profits, and its future, you don't react to the market's mood swings. Graham says, "The market is there to serve you, not to instruct you." A smart investor acts like this. When prices fall, he doesn't panic. When prices rise, he doesn't get greedy. He makes decisions not emotionally, but consciously. The winner isn't the one who predicts every up and down, but the one who knows when to sit still and when to act. Panic and greed are the investor's worst enemies. Calmness and analysis are his best friends. That's why true investment wisdom sounds like this. You don't need to win every round, you need to win the long game. In the long run, victory belongs to those who understand value, not to those chasing noise. Graham clearly separates 2 ideas: investing and speculating. Investing is calm and thoughtful. It's like buying a house you plan to live in for many years. You check the neighborhood, the utilities, the documents, the condition. You don't buy a house hoping to flip it for profit next week. Speculation is the opposite. It's like buying a house just because your barber told you, "Dude, the real estate market is about to go to the moon." You have no idea what's inside, who the neighbors are, or whether the roof even exists. You just hope someone will pay more for it later. Here's the problem. Most people think they're investing, but in reality they're just placing bets in a casino. They buy hot stocks, meme tickers, follow random influencers, and never bother to understand the actual business. Now imagine this. If I offered you to buy a slice of a pizzeria you've never seen, you don't know the owner, the menu, or the profits, would you buy it? Of course not. But people do exactly that with stocks every single day. Graham says, a stock is a share of a real business. You're not buying a ticker, You're buying part of a company with employees, revenue, risks, and debts. If you wouldn't buy the whole business, why buy a tiny piece of it? Let's look at what happens when people confuse speculation with investing. In the late 90s, there was the dot-com bubble. Any company that had .com in its name was automatically considered the future. People were buying stocks of firms that had no profit, no product, no real plan, just a website and fancy words. Prices were skyrocketing at insane speed. Everyone was shouting, "This is a revolution, buy right now." And then boom, the market crashed. Thousands of companies went to zero. Millions of people lost money. Why? Because they weren't investing. They were speculating. People were buying hope, not value. Graham explains a golden rule. Investing equals analysis plus capital protection plus reasonable return. No analysis? That's speculation. No capital protection? That's a casino. Expecting to get rich in a day? That's a lottery. Remember one simple rule. If you can't explain how a company makes money, don't buy it. Don't want to study reports, financial metrics, or business models. Then choose the simple route index funds. Their purpose is to buy the whole market instead of trying to guess winners. Speculation is emotion. Investing is understanding. One of Benjamin Graham's strongest ideas is the margin of safety. In super simple terms, don't pay full price even if the company is amazing. Why? Because in the real world, things go wrong. You might miscalculate something. The company might screw up. The market might suddenly fall into a depression. Graham says, a sensible investor always leaves room for error. Imagine you're building a bridge meant for trucks weighing 10 tons. The engineer doesn't design the bridge to handle exactly 10 tons. He builds it for 20-30 tons. Because unexpected things always happen. It works the same with stocks. Let's say you evaluate a company and decide its true value is $50 per share. A rational investor doesn't buy at 50, and not even at 45. He waits for something near 30 or even lower. This gap is the margin of safety. It protects you from mistakes, market panic, and surprises. During crises, great companies regularly go on sale. 2008, 2020 people were panic selling everything, and investors with a cold head were buying real value at a discount. Warren Buffett puts it simply, the market transfers money from the impatient to the patient. Margin of safety equals patience plus discipline. Here's a classic mistake. Someone loves a company and thinks that automatically means I should buy its stock right now. But Graham explains, an excellent business at an overpriced cost is a bad investment. Imagine you're a huge Apple fan. You've studied the company, you believe in its long-term future, but the stock keeps shooting upward, hitting new highs every day. You start feeling FOMO, the fear of missing out. You want to jump onto the train while it's still going up. But a rational investor doesn't chase moving trains. He knows the market is cyclical. Today is euphoria, tomorrow is panic. Graham teaches, the price should give you comfort, not stress. If a stock is too expensive, leave it alone. Put it on your watch list. Wait. Follow the business, not the chart. Sooner or later, Mr. Market will fall into a depression again and start handing out discounts. And that's when you act. That's the difference between a professional and a gambler. The speculator buys when emotions scream, right now! The investor buys when the price gives him protection. You win not by making more trades, but by making better decisions. Not by speed, but by patience. Graham says you can't sit between two chairs in investing. There are only two paths, and you need to know which one is yours. The first one is the defensive, passive investor. The second is the enterprising, active investor. Imagine a gym. A defensive investor is the person who comes in just to stay in shape. They jog on the treadmill, lift a bit of weight, and go home. They're not competing, not chasing records. They want results without unnecessary stress. In investing, this looks like buying broad index funds like the S&P 500, investing regularly every month, not trying to predict the market, keeping emotions and actions to a minimum. This is the strategy most people use, and it works. Now the active investor is a completely different type. This is the person who doesn't just visit the gym. They live there. Meal plans, training programs, progress tracking, journals. They want to win, not just stay in shape. In investing, that means analyzing companies, reading financial reports, looking for undervalued stocks, making independent decisions. This path requires discipline, knowledge, and time. Graham puts it simply, if you're not willing to do the work, be a defensive investor. The problem is that most people think they're active, but act emotionally and chaotically, and that's exactly where money is lost. Graham says something that's hard to accept, but impossible to ignore. The investor doesn't lose to the market, he loses to himself. The problem isn't the stocks. The problem is our emotions. When the market goes up, greed kicks in. I need to buy. Everyone's making money. I can still catch the wave. When the market drops, fear takes over. It's all over. I need to sell before it gets worse. These are the exact same emotions a gambler feels at a roulette table. Your thoughts become chaos. Yesterday, I felt like a genius. Today, I feel like an idiot. Yesterday was euphoria. Today is panic. All because of numbers on a screen. Look at history. The 2008 crisis, the dot-com bubble, the 2020 crash. In every case, some people panicked and sold, and others stayed calm and kept buying quality businesses. Guess who ended up richer? Not the ones who tried to predict the market, but the ones who kept a cool head. The real superpower in investing isn't intelligence, it's emotional discipline. How do you build it? Have a strategy. Invest regularly, dollar cost averaging. Don't make decisions under emotional pressure. A pilot doesn't grab the controls in panic during turbulence. He follows the system. Investing is the same. And here's the whole book in one sentence. Investing is not about predicting the market, it's about controlling yourself. Remember the 5 rules. Mr. Market is your servant, not your teacher. Don't speculate. Buy businesses, not tickers. Always demand a margin of safety. Choose your path, passive or active. Emotional discipline beats intelligence. Use this and you're already ahead of 90% of people. Thanks for watching. See you in the next episode.